What's going on, everyone? It's Gene with My Real Estate Venture, and today we are going to be talking about the fundamentals of your credit score. Now, why do I want to talk about the fundamentals of your credit score if this page is all about buying houses and real estate and property management? Well, the answer is very simple, and it's because for most of us, if we want to buy our very first house, we're probably going to want to take out a loan. That's just plain and simple, unless you have an extra $100,000, $200,000 to $500,000 just laying around that you're not doing anything with, and you want to buy a house outright. Absolutely, you can do that in cash. But for the average American, for the average person who wants to buy a house, they're probably going to go the mortgage route. And when you buy a mortgage, or when you take out a mortgage, the bank or the lender is going to want to know what your credit score is. And so I thought, instead of me telling you about all the different mortgages that you can get into and all of the different types of loans that you can get, I thought, why not give you guys a foundation so that when you are ready to go out for these mortgages and you are ready to go out for these different types of loans, you've already done everything on your part to make sure that you can get approved for those types of mortgages and loans. So let's get right into it by talking about what is your credit score. Well, for those of you guys who don't know, your credit score is basically a 3-digit number between 300 and 850, okay? And these 3 digits are compiled by 3 credit bureaus, and those are Experian, Equifax, and TransUnion. Now, okay, banks will actually look at that credit score, look at that credit rating, and determine whether or not they want to trust you with their money. Because what a credit score is essentially is a rating that shows your ability to pay back money that you owe. So I want to talk about what your credit score consists of. And to be honest with you guys, up until doing the research for this video, I don't think I knew as much as what I'm about to share with you. So this really, the stuff that I'm about to give you is really going to lay down the foundation for when you are working on your credit score, that you can really excel as quickly as possible. Okay, so I want to talk about what exactly does your credit score consist of? What is making your rating go up? What is making your ratings go down? Now, the very first thing that your credit score is tracking is your payment history, okay? And actually, your payment history makes up about 40% of your whole credit score. So think about this. If you had a test and one question was worth 40%, you might really want to take your time to get that one question right, because that's a lot of points on one question. Well, that's similar with your credit score. Paying your debt on time is 40% of what makes up your credit score. Now, notice I said paying your debt on time, and I didn't say paying it off completely, because your payment history is just tracking that you are paying off on your loans. So, for example, if you have a $2,000 loan, you don't necessarily have to pay off $2,000 to get the full 40%. You just need to be making the minimum payments. So as long as you're making minimum payments and you're not getting late payments, that's a positive in your credit score, and it's worth 40%. Now, the second thing that your credit score is tracking is how long have you had your credit, and that makes up 21% of your total score. This is the second most important because it shows how long you've been able to manage other people's money and how well have you been doing it since you've been doing it, essentially. So someone who's had maybe a credit card for a year is at a disadvantage in a way compared to someone who's had their credit card for 5 years, because the person who's had their credit card for 5 years can show a track history of them consistently paying off debt, while the person who's had their credit card for a year, they only have about 11 months of history to show. And so that's why I would recommend that you find a way to actually start building your credit as soon as possible. One of the ways that you can do that is with a secured credit card. We're going to talk about that a little bit later in this video, but for right now, let's go on to what else is your credit score tracking. Okay, so the third thing that your credit score is tracking is your credit limit and how much of your credit limit are you using, and that takes up about 20% of your total credit score. So what is a credit limit? So your credit limit is basically when you combine all of your lines of credit, all of your credit cards, TJ Maxx, Home Depot, Walmart, Lowe's. When you combine the amount that you can withdraw from all of those credit cards, what is the total amount? So let's say you've had, for easy math, 3 cards, okay? And on each card you had $2,000, okay? Your credit limit would be 3 times 2,000, which is 6,000, okay? So that gives you a credit limit of $6,000, all right? Now, the second part of that is how much of that are you using? Now, this is the important part, right? It's not enough to just have the credit limit of $6,000. There is a certain ratio that you have to make sure that you're using in order to have positive results on your credit score. Typically, you want to be using around 1/3 of your credit limit. Okay, yep. So 1/3 of your credit limit. So that $6,000 credit limit that you had, you really want to be using $2,000. You really want to be using $2,000 of that credit limit. That is crucial, okay? One, just speaking from personal experiences, I've noticed when I'm tracking my credit score, whenever I've gone over that 1/3, so about 33% of my credit limit, my credit score starts to go down. It happens every time. Whenever I'm below that third or right at the third, my credit score slowly starts to go back up, okay? So make sure you guys are using 1/3 of your credit limit no matter what it is. And listen, I get it. Things happen in life and you might have to go over it sometimes, and I do, but for best practices, okay, if you really are serious about buying a house, for best practices, you want to try to stay within 1/3 of your credit limit at all times. So with that being said, the other thing that your credit score is tracking is how much debt do you have, and that makes up 11% of your credit history. And this is a big one, because not only is your credit score tracking this, but you're gonna find out when you go to buy a house, the banks are gonna wanna know how much debt do you have, because they wanna know that you're gonna be able to pay them off and that you don't owe, so much money that you can't afford to pay them off and pay off whatever else you owe. So your credit score will track the debt that you have, and it will actually factor it into your credit score. So make sure you are paying off your debts. I know just earlier I said that you pay off the minimum, but if you're paying off the minimum, it's going to take you a very, very long time to actually pay off your debt completely. So always try to put in as much as you can towards your debt and pay a little bit more than the minimum at all times. The next thing that goes towards your credit score is new credit accounts, okay? I know some of you guys, if you are tracking your credit, you know that whenever you open up a new credit card, you get a new loan, okay, your credit score will drop a little bit. That's because new credit accounts take up 5% of your total credit score. So every time you go out and you go to Best Buy and they offer you a credit card for 10% off, and you go to Old Navy and they offer you a credit card for 20% off, every time you accept those, your credit score is actually going down, okay? So make sure, one, my advice to you is to not open up credit cards randomly, okay? That's one thing I'm surprised I'm really good at. I don't open up random credit cards. Like when I go to Old Navy and they offer me the 20% off for a credit card, in my head, I'm like, I don't even shop at Old Navy often enough for me to need a credit card. If this is not a place that you're shopping at all the time, chances are you don't need the credit card just for the 20% off, because it's hurting your credit score. But if it is somewhere that you do shop at all the time, maybe Walmart, you're there all the time for your kids or whatever, getting a credit card might actually help you out, because if you're able to pay that off on time, then we're going back to that on-time payment, and that's a huge boost in the other direction, going up compared to the 5% that you lost to open. And the last piece of what makes up your credit score is available credit, okay? And this is kind of similar to when we talked about your credit limit and how much of your credit limit are you using. Well, your available credit is just how much do you have available. So you have an additional 3% going towards how much of your credit limit you have left. So that should be an extra incentive to not use up all your credit cards. Don't go all the way up to the max on all your credit cards, okay? Try to stay within that 1/3 range. Another piece that your credit score actually tracks, and I want to bring this up because if you're going to buy a house, this is important, and that is your hard inquiries. What is a hard inquiry? When you go to buy a car, when you go to buy a house, those are considered hard inquiries, okay? And basically, those take a really big pull on your credit score, a really big pull. Usually, whenever you get your credit score pulled for stuff like that, it's gonna dip quite a bit. But the good news is it will go back up, and it will go back up fairly quickly. But just be aware that hard inquiries are something that are on your credit card, and it's something that can stay on your credit card for at least 2 years. Something else that falls under hard inquiries is actually collections. And that one is a negative one, and you really don't want that on your credit score at all. And really, you don't want too many hard inquiries on your credit score at all. That's another bad sign as well. So really, you want to keep your inquiries to below 13. But with that being said, the longer you've had your credit, and especially if you're in the real estate game, it's probably going to go a lot higher than that. So don't sweat it too much. Like I said, the minute you pull your credit for a house, your credit score will tank quite a bit, but within a couple months, it will go right back up to where it used to be, as long as you continue to make your on-time payments. And if you do get your house, you're paying off your mortgage, that is going to really bring up your credit score as much as possible. What's up, everyone? If you made it this far in the video, I want to thank you. I really appreciate that. And if you've gotten anything out of this video, please go ahead and hit the like button. That lets YouTube know that you like the video and that you got something out of it, and that lets other people know that this is valuable information. I wanted to cut this video in half just because there's so much information in here that I think this could easily be a 20-30 minute video, and it is. So next week, we're going to talk about what you can do to actually improve your credit. So I'll see you next week.